Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing WELL Health Technology stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. WELL Health Technologies is a digital telehealth company and is also a provider of billing and cybersecurity related technology solutions. It currently owns and operates 75 healthcare clinics in Canada and 2 clinics in the US. The company's wholly owned subsidiary, CRH Medical, provides services in 78 ambulatory surgery centers across 16 US states. The company's mergers and acquisition strategy is based on acquiring additional clinical and digital assets. It seeks to acquire cash-generating companies which lead to increased cash flows that are then reinvested to make additional cash-generating acquisitions. That's a quote according to the latest quarterly report. It has acquired dozens of companies since starting out, and that is a big reason their revenue is growing so much. The company is focused on the implementation of digital technology solutions in its own clinic network, and then selling solutions to other practitioners and medical clinics worldwide. The company provides SaaS EMR services to doctors across Canada. SaaS stands for Software as a Service. EMR stands for Electronic Medical Records. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 2010. It trades on the TSX under ticker WELL, W-E-L-L. It also trades on the pink sheets in the United States under ticker WLYYF. Let's get started with the model. This is a small cap company, 866 million market cap. They're trading at $4.20 a share, and they have 206 million shares outstanding. We're looking at the ticker that trades on the TSX, so all the numbers in this video are in Canadian dollars. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they had negative free cash flow every year except in the trailing 12 months. They had their first positive. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year. Revenue is the sales for the company, and that grows amazingly from 6 million up to 204 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain their website is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that grows from 2 million to 98 million. Their growth is phenomenal. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Research and development is an example of one of their operating expenses. Gross profit minus operating expenses gives you your operating income, and that's negative every year. They spent $4.5 million of interest on their debt, which is the most they've spent in a 12-month period. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example is an asset impairment. Below that is their pre-tax income, then their taxes, and then their earnings from equity interest. This is the company's earnings or losses on their investments in other companies. That was a loss of $500,000, and the bottom line of the income statement is their net income, which is negative every year, and they had their biggest negative in the trailing 12 months. But they're in hyper growth mode, so they're going to have negative net income for a while. This is the company's income statement from their latest quarterly report. This shows us the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, the second quarter of 2021, and the third quarter of 2021. The top line is the revenue. It was 12 million in the third quarter of 2020. Now it's close to 100 million. Most of the growth is through acquisition. Here's their quarterly revenue and net income for the last 8 quarters. I would ignore net income. I would just focus on revenue for this company. Their revenue grew 10x, 9.8 million to 99 million. If you're looking to grow your revenue and you have a business, learn how this company did it. They figured out the secret formula. 35 million of their revenue is from public insured, 46 million is from non-public, and 18% of their revenue is from virtual services. Public insurance is healthcare that's reimbursed by the government. Non-public is healthcare that's paid by the client or their insurance provider. Below revenue is their cost of revenue, that was $49 million, and their gross profit is $50 million. Their gross margins are 50%. That's gross profit over revenue. The median for the 61 companies in their industry is 26%. The average is 31%. So they're much more profitable than the average company. We cannot look at their net margin since they still have a net loss. Since they have a net loss still, let's focus on EBITDA, earnings before interest, taxes, depreciation, and amortization. In the first 9 months of 2020, it was negative $1 million. In the first 9 months of 2021, it was $35 million. So it looks like things are improving. And it doubled from the second quarter to the third quarter. Here's a breakdown of some of their expenses. $16 million of depreciation and amortization. Then you have income taxes, interest expense. So it looks like they took on a lot of debt. Their interest expense was over $3 million in the third quarter. In the second quarter, it was $1.4 million. Rent of $1.9 million. $9.4 million of stock-based compensation. That's more than double from the second quarter of $4.3 million. $3.5 million of their EBITDA is in Canada. $18.8 million in the US. They are diluting their shareholders. They're up to 204 million shares outstanding. It was 188 million in the third quarter of 2021, 134 million in the third quarter of 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So it's pretty impressive they had over 10 million of operating cash flow in the trailing 12 months. It was negative before that. They do invest a little in CapEx. Mainly it's to improve their technology, their websites and their apps. That was 1.2 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And that was positive 9.2 million, negative in 2020. Since they're not generating cash flow, they need funds from somewhere to run their business and also to continue acquiring other companies. They mainly do it through capital stock. They added 118 million in 2020, 383 million in the trailing 12 months. When a company adds common stock, it increases the shares outstanding and makes your shares less valuable. Most of the funds they're raising are used to acquire other businesses. Diluting shareholders to acquire other businesses is fine, as long as the return on that acquisition is greater than the amount you diluted your shareholders. And they did add a lot of debt in the trailing 12 months, over 100 million. You can see their CapEx is really low. CapEx is part of investing cash flow. Also part of investing cash flow is acquisitions. So you can see they did lots of acquisitions in the trailing 12 months. They've also done some acquisitions in 18, 19, and 20. They've acquired close to 100 companies, but most of the acquisitions are pretty small. If you summed up all the money they spent on the acquisitions, 4 of the companies make up more than 90% of that sum. Let's look at the capital structure. 600 million of equity, 400 million of debt. They're 61% equity, 39% debt. Their net debt is 334 million. And I gave them the lowest whack on Finbox, 8.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7, that's $2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.3 billion. We divide that by 206 million shares. And we get a calculated stock price of $6.46. They're trading at $4.20, so they're trading at a 35% discount. It's a buy according to the model. Their annual revenue is projected to increase 36.5%. So I grew their revenue 36.5% for the next 7 years. That's how I got their future revenue estimates. The average company of their industry converts 8% of their revenue into free cash flow. So I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $20. They're saying it's 79% undervalued. This is where the stock has been trading the last 2 years. Before 2 years ago, you could have got the stock well under $1 a share. But when COVID hit, there was a lot of excitement about this stock, and the price got pushed way up to over $8 a share. Then it was trading sideways for about 9 months. and lately there's been a big sell-off. Even though their revenue is growing a lot, I think people are losing faith in the company. When a company's losing money, investors have to base their decision on the future. Will the company make money in the future? Investors don't feel this way since they're selling off the stock. But if you feel they're going to be profitable in the future, this could be a really good value because the stock has come down a lot. I do have a feeling it's going to come down to around $3 a share, and then it's going to shoot back up. That's just my guess. But I do think this company has a great future. They have a really good team, and they are doing a good job at growing their brand through acquisition. They have a beta of 1.16, so the stock is a little more volatile than the market. It's gone down 46% in the past 52 weeks, while the S&P is up 23%. The 52-week low is 4, the high is 10, and the stock is trading below its 50-day and 200-day moving average. Over 1 million shares are traded each day on this stock. Of the 206 million shares outstanding, 191 million are on float. Only 4% are held by institutions, and 3% of the shares are shorted. 85% of the shares are held by the general public, 8% by insiders, and 6.5% by institutions. The CEO of the company owns 6% of the stock. The next biggest shareholder is 3%, Manulife 1.5%, another insider 1.4%, and BlackRock 0.5%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is 4.2, that's stock price over sales per share. The market average is 9.4, the median is 2.8. And the way you calculate sales per share, it's revenue over shares outstanding. Another way to calculate this ratio is take the market cap divided by the annual revenue. Price to book is stock price over book value per share. That's really good at 1.5. Market median is 3.1 and market average is 8.7. The way to calculate book value per share is equity over shares outstanding. Equity is on a balance sheet. It's assets minus liabilities. It's the value of the company according to the balance sheet. But they have lots of intangible assets because they acquire many companies. Their tangible book value is negative 293 million. Another way to calculate this ratio is take the market cap divided by the equity. Their current ratio and quick ratio are 1.0, so they can cover their current liabilities with their current assets. Let's look at their current assets. 39 million of cash, 33 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. The company should mention in their reporting what the restricted cash is supposed to be used for. 62 million of receivables. This is how much money other companies owe well. 2 million of lease receivables and 11 million of other. They did generate 9 million of free cash flow in the trailing 12 months, and they have 3 million of working capital. Working capital is current assets minus current liabilities. They should have enough funding to get through the next 12 months without adding any more debt. Their business model is to acquire companies so they can scale and grow, and also make their technology more efficient. The best way to look at ratios is to compare them to companies in the same industry. There are 60 companies in the industry medical care facilities. In terms of CapEx, they really don't spend too much. The average is 219 million. They only spend 1 million. They have a low debt to equity ratio, so they're much less leveraged than the average company. They don't pay a dividend. They may in the future. They do have positive free cash flow, but it's much smaller than the average. I converted all these numbers to Canadian dollars, even though these are American companies, because I want it to be equal to WELL. In terms of market cap, they rank 38th out of the 60 companies. The average market cap is 4.7 billion Canadian dollars. Their price to book is a lot better than the average company, but their tangible price to book is negative, so it's probably worse than the average. We can't look at their price to earnings since they have negative earnings. Their price to free cash flow is much worse than average. Their price to sales is also worse than average. Their revenue is tiny compared to the average in the industry. Their 5-year annual growth rate is through the roof, 142%. And they have a negative ROA and ROE, since a numerator of those equations is net income. So to summarize, I have them trading at a 35% discount, and digital telehealth is the future. It's so much more convenient than having to go into a doctor's office. And I know in Canada there's a lot of inefficiencies. where one doctor has no idea what another doctor is doing. So when you build a cloud-based system, so all these companies talk to each other, it not only makes things more efficient and saves money, but it also saves lives. They do have a really good management team with lots of experience in the medical field and the technology field. So this could be one of those stocks you 100x on. But the problem is the waiting game. You may have to wait many years or even many decades to see those massive returns. And as Tom Petty says, waiting is the hardest part. I ranked their free cash flows 5 out of 10, their revenue 8 out of 10, and a ratio of 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member on YouTube or Patreon by clicking on the link in the description below. Thanks for watching.